Hi, welcome. I'm Professor Ashok Patil and we'll be talking about financial derivatives, the third session. This is going to be an overview of the positions which we take in the forwards and futures market. We have seen in the previous sessions that what are forwards and what are futures. The forwards are the contracts between the two parties known to each other of the exchange, that means it is over the counter, and the terms are decided by themselves to settle the agreement. That is a forward contract. In the futures contract is a legally enforceable contract signed between two parties. The terms and conditions of the contract are decided today and standardized, and it is traded on the exchange. The parties may not know each other, and that is what the future says. So we are going to look at the positions which normally are taken by the people in the market. And just to summarize the part things which we did in the earlier modules was derivatives can generally be classified in two parts. One is the forwards and the futures, and the second part is the options. And we are also seeing that in the forwards and futures we can take a long position and a short position. Similarly, in the options, however, we have two further classification, sub-classification, which is nothing but calls and puts. And in each one of them, you can go long or short. And we are focusing on the forwards and futures, long position and the short position. So the long position, as we discussed earlier also, is regarding the expectation of the future. If the trader, that is hedger, is expecting the price of the underlying to go up in future, then he would enter into a contract in the position of long. So he will take a long position because he expects the prices to go up in future, and therefore he would like to lock in the price today. I would like to also tell you how that particular picture looks like in terms of time. So if it is January here and March here, we can see that the spot market position and the forwards or the futures markets position here. So spot market, the price is 50 and it might fluctuate over the period in different ways, and it might go to 52, 48, or it can be even same 50. But in the case of forwards and futures, we have seen that since it is a contract, the price will remain same if it is a forward. If it is a futures, the price may fluctuate because the futures are required to trade it, allowed to trade. Right? It will be fluctuating. So we can see that if the contract price is going to be 52, you lock in the price at 52 for the forwards, and in the futures, depending upon how the market fluctuates in the futures market, the price will change, and therefore your position in the market will change. Now we have seen that there are two different markets. Therefore, something is required by the firm to be done in the spot market. It has to be done and it will be done in the month of March. So for example, if the company is required to buy certain goods in future in the month of March, and it knows that presently the price is 50, it can wait, do nothing in the forward market, just wait and see that whatever the price happens in the month of March, can buy at that price. Now you can see that if it does nothing and the price goes to 52, it has to buy the goods at 52. So there is a 2 rupees notional increase in the price because he has not purchased here. See, otherwise the company can purchase this good today itself, store it, and then use it in the month of March. The alternatively, this other option is that if they don't do anything and the price happens to be 48, they will be happy because they will be purchasing the goods at 48 rupees. So there will be going to be a gain of notional gain here of 2 rupees compared to its 50. But then future is uncertain. Nobody knows what is going to be the future, whether it is going to be 50, 48 or 52. So nobody is aware of that. So the people who are at the helm of the affairs will have to take the risk and say that, okay, can that risk be mitigated? And that can be mitigated by signing a contract today, either the forward or the futures, to say that, okay, if the forwards are available at 52 today, that means it is the expectation of the people in general, the traders who are investing in this, particularly speculators, that the price of this underlying in the future might be 52. By doing so, the market is actually discovering the price for the future. And for the hedger, the company which want to buy the goods in the month of March, by signing the contract, they will fix this price for the underlying commodity. How is what we are going to see through the example. So we have seen the long position is this position, and we can see that if the contract price is 40 and the futures price fluctuates in the market depending upon what is happening in this spread. So we are talking about this particular part, which is the futures. You can see that forwards is constant, there is no change in the price of the forwards, but when it comes to the futures, we can see that even the futures price increases or decreases accordingly, right? So you can see that if contract price is 40 and the futures price goes to 50, then the person who has signed the contract at 40 will buy at 40. Whatever happens to the futures price in the market, he will buy at 40. And since it is being traded at 50 presently, he will sell the futures contract at 50 and he will has bought at 40. So there is a profit of 10. And this we have seen the previous class. And similarly, if the futures price goes down, we can see that he has made a loss of 10. That means if your expectations go wrong about the future, you are going to make a loss. What was the expectation of the long futures person? The expectation of the long futures person was that the price of the underlying will go up in future, and therefore the we want to fix the price for the future. And if that expectation goes wrong, that means instead of the prices going up, if the prices go down, you can see that there is a loss in that particular position. So one can see that there are two markets. One is the spot market, which has to be done, and the other one is the forwards and futures market, which is a contract, where the physical goods are not being traded, but the contracts are being traded here. The position of the contract changes depending upon what is happening to the underlying in the spot market. Example, suppose there is a firm and it observes that the June crude oil futures is trading at 40 and each futures contract covers 1000 barrels of crude oil. Now, a futures trader enters a long future position by buying one contract of June crude oil futures at 40 a barrel. So that means the company observes this and it wants to buy the crude oil, and therefore it wants to buy the crude oil at 40 because that is the current futures price which is available, and that is trading at 40 today. Scenario 1, now what happens if the futures price rises to 50? That is scenario 1. If that happens, then you can see that on delivery date, the long futures position will gain of 10 because 50 minus 40. 50 minus 40. Now, 50 minus 40, 10 is the gain over there. Since the contract size is 1000 barrels, 10 into 1000, each contract covers the 1000 barrels, then you can see that 10,000 is the total gain which is achieved in the futures market. So let's draw it here on the board. So one can see that this is the gain region, this is the loss region, this is the futures price which changes over the period, and this is the contract price of 40. Now if the futures price goes to 50 in the month of June, obviously the person will get a gain of 10, and then you can see that these two lines can be joined, and similarly we can do for other points, and then you can see that it becomes a straight line. So the gain of 10 per unit is achieved if the price of the futures goes to 50 in future, whereas the contract price is 40. So from the contract price of 40 it goes to 50. So 10 rupees is a profit which is there, and such 1000 barrels are there in each contract, and therefore the total amount comes out to be 10,000. Now look at the scenario 2. What happens if it goes down to 30? And similar argument can be seen that, and then we can see that there is a loss of 10,000. So if it goes to 30, then we know that it has to buy at 40, whereas selling will happen at in the market at 30. So therefore it has bought at the higher rate and sold at a lower rate. So there is going to be loss of 10. This is plus 10, this is minus 10. So you can see that the futures price fluctuates accordingly, the profit and loss of the contract also fluctuates. So if the futures price goes according to the expectations of the buyer expects that the future price should go up, and if that happens there is a gain. And if the buyer expected to go up and then the market goes down, then obviously it is against the expectation of the trader, and therefore we can see that it is a loss of 10 per unit, and therefore if there is a contract of 10,000 barrels, there is the loss of 10,000. Similarly, you can actually generate many points on this line and see that above the contract price there will be a gain for the long position, and below the contract price obviously there will be a loss for the long position. Now once you understand this, the next points are very easy, because you can see that what is the short futures position obviously. Then one can see that if, so looking at, I am using the same idea of the long futures, one can calculate how the short futures are actually calculated, the payoffs. So you can see that this is the gain region, this is the loss region, this is no profit, no gain, this is the futures price. Okay. Now the condition here is that when we would like to take the short position in the futures market, as we seen in the long futures, you expect the price of the underlying to go in the market, up in the market. In the case of short position, when you expect, on the other hand, the price of the underlying is going to go down, and you are required to sell something in future, and the prices are going to go down, obviously you would like to fix that price today itself. If you know that the price is going to go down and you are required to sell in the future, obviously you would not like to wait till that point where the prices go down and you sell at a lower price. Say for example, the firm which is manufacturing goods or flour and bakery, we can take a standard example. So the bakery person has to sell, buy the goods, and then he has to sell it to the wholesaler. Now if the bakery person knows that the price of the bakery product is going to go down and he signs a contract today, then that will have to be a short futures. Why and how, we'll say. For example, this is the contract price which is, let's denote it by say C, and he is required to sell at this point C. If in future, as he expected the price to go down, suppose it goes here, but he is selling at C because he has signed the contract, that means he will be gaining a profit here. I'll just repeat. Since the contract is to sell something in future at this price, he will be selling the underlying at this price C. What may happen to the spot price, and therefore you will see that he is going to gain in this. Similarly, if the price goes up, contrary to the expectation, the price of the product goes up in the market, he could have sold his product in the open market, but now he cannot because he will be signing this contract. He has already signed the contract, and therefore he has to sell at this lower price, and therefore there will be loss. So if you join these points, you can see that this is exactly opposite position of the long position. So long and short are exactly opposite positions. The long position is taken by the hedger when he expects the price of the underlying to go up in future. The short position is taken by the hedger when the investor expects that the price of the underlying to go down in the future. And remember that when I'm saying that underlying, the underlying price will determine the futures price, and therefore when the underlying is expected to go up, even the futures price is expected to go up in future accordingly. So we can see that this is how it looks, and suppose the same example we look at with the short perspective, the same contract trading at 40, but you are required to sell, and scenario 1 is that it drops to 30, then what happens to you? So since your position is of selling and the market price is gone down, and you will be selling at contract price of 40, there will be gain of 10 rupees per unit, and since 1000 such units are covered by each contract, you can see that the total amount which is profit is $10,000. Similarly, you can see that if June crude oil futures rises to 50, opposite is the case, and you will make a loss of $10,000 in value in future. Now we have seen these long and short futures position. When these positions are taken by the hedger, it is called long hedge, right? And it is sometimes also called as input hedge because it will decide the commodity to be purchased in future for the input of the company. Therefore, it is called input hedge. So the long hedge involves taking up a long futures position. Should the underlying commodity price rise, obviously there will be gain in the value of the contract, and therefore there will be profit. It will offset the price, offset the cost which will be paid in the spot market. If the spot market prices goes up, but you are buying at a lower price, so it is actually saved you from the additional cost which is incurred in the spot market. So now we'll take one example, which suppose in May, a flour manufacturer had just inked a contract to supply flour to a supermarket in September. So he will be supplying the flour to supermarket in September. Let's assume that the local total amount of wheat needed to produce the flour is 50,000 bushels, and based on the agreed selling price of the flour maker calculated that he must purchase wheat at $7 per BU or less in order to break even. Now see, this example is multiple faceted. We are talking about the flour maker who is supplying the flour to the supermarket. We are not talking about the supermarket, we are talking about the flour maker. The flour maker has to purchase the wheat at $7 per BU or less in order to break even. That is the given information. At the time, wheat is going to be is going for 6.6 per bushel at the local elevator. So present price is the present price is 6.6 per bushel. The wheat futures for the September are trading at 6.7 per bushel, and therefore the flour maker wishes to lock in this purchase price of 6.7. So if you sign a contract today, what may happen to the spot market 6.62, whatever, it doesn't matter to the person who is signing this contract. What matters to is that how much the futures contract price is changing, and then accordingly he signs this contract and wishes to lock in this price, and therefore he signs this contract. So now what happens? Which futures contract covers 5,000 bushels? He will need to buy 10 futures because he needs to buy 50,000 bushels. In August, the manufacturing process begins and the flour maker needs to purchase his wheat supply from the local elevator. However, the price of the wheat has since gone up and the price has risen to 7.2 per bushel in the spot market. You can see that in the spot market. Correspondingly, as you've seen that as the underlying price has increased, even the futures price has also increased, and then you can see that the futures have risen and are now trading at 7.3 per bushel. Now that is what is happening, right? So the futures market also is fluctuating and it has gone from 6.7 earlier to 7.3. So obviously, since the prices have risen, the person, the flour maker could have purchased at 6.6, but then in the real market, in the spot market, he has to purchase at 7.2. So there is a loss, notional loss of 30,000. But however, since he has signed the contract in the futures market, his futures market is in the profit position because we've seen that he has signed at 6.7 and the price is 7.3. So the difference of those comes to be 3.35. And when it is sold, it comes out to be 3.65. So the difference is of $30,000. So he has made a gain of 30,000 in the futures market, whereas in the spot market there is a notional loss of 30,000. So the loss which is incurred in the spot market has been actually compensated or offset in the futures market. So therefore, the overall profit is 0. So this is how the long hedge for the manufacturer works, that the condition of the manufacturer is to do some activity in the spot market, and to hedge that spot market activity, the manufacturer will enter into a contract in the futures market. Now, as we have seen in this example, that how the loss in the spot market has been compensated or offset by the gain in the futures market. That is how the futures markets work. It actually mitigates the risk which is generated by the spot market. The spot market risk is mitigated by taking a position in the futures market. So futures will provide the hedging to the basic exposure to the underlying. So as you've seen that although the price of the wheat has increased in the spot market, the buyer, the flour manufacturer, has